Thank you for joining us. We'll be getting started in just a moment. Welcome to the Addition Financial webinar, Purchase Pointers 101 Home Buying Tips. Our speakers tonight are sharing their expertise are Catherine Michaels, Joy Winslow, and Chris Alianello from our Real Estate Lending Department. Feel free to type your questions in the chat box and we'll answer them during the Q&A session towards the end. And now I'll hand it over to Joy.
Welcome. I'm here today to help you learn the process of getting through a mortgage application and closing on your home. Your first thing you should do is check your own credit to be sure what's on it, what debts you have, and dispute anything that's an error. After that, you can call and get pre-approved for a mortgage, choose the right mortgage, comparison shop lenders, submit an application, then the file will go to underwriting, prepare for closing, and we'll close on the home. So let's go into a little more detail. Know your credit. Credit scores range anywhere from 300 to 850. To get a mortgage, typically you need at least like a 620 credit score. Credit score is a number that's used to predict risk for lenders. To create a credit score, analysts use information in credit reports, account histories, or applications. Their goal is to accurately identify the consistency of your timely paid accounts, as well as your delinquent accounts. The result of this is all computed and analyzed, and it comes up with a number that is your credit score. There are 3 credit scores that we pull, and we use a middle score. How is your score arrived at? Well, here's some of the things that affect your credit score. 35% is your payment history, whether you pay on time, whether you pay the minimum balance. 30% is utilization of credit. If you have a high available credit, how much of that do you have that you've used? Third item is the length of credit history. That's 15%. 10% is a mix of credit accounts. Do you have a variety of credit, such as credit cards, auto loans, mortgages, or student loans? Finally, the last 10% is, have you applied for credit recently? That could affect your score if you've opened new credit. Many people focus on the attention on relatively minor scoring factors such as inquiries rather than the biggies such as making timely payments or keeping debt low. Debt to credit ratio is a big factor. If you currently are utilizing all the available credit, that is going to bring your credit score down. For example, if you have 3 credit cards, each has a balance of $100 and a credit limit of $1,000, you have $300 in debt and available credit of $3,000. Your credit utilization or debt to credit ratio there is 10%. Your credit score increases when your ratio improves. People who use less of their available credit are considered low risk. Your debt to credit ratio is one of the only factors impacting your credit score that you can use to influence your score in a matter of weeks. Depending on your total available credit, closing a credit card account with a high credit limit could hurt your credit score, particularly if you have a high balance on other cards or loans. The time an account has been opened is also positive for the longer the account's been open. When considering length of credit history, the scoring formula evaluates the ages of your oldest and newest accounts along with your average age of all your accounts. The minimum amount of credit history needed to generate a FICO score is 6 months or more of at least one credit account. Closed accounts with zero balances and no associated negative information typically remain on a credit report for 10 years from the date they are reported closed. Having a variety of credit types may increase your score. Installment loans, mortgage loans, bank credit cards, and retail credit cards. Gas credit cards and rental data. When you apply for a loan, its result is called a hard credit inquiry, which happens when a bank checks your credit history to decide if they should approve you for a credit card or a loan. Only hard inquiries negatively impact a borrower's score. For most people, it amounts to a loss of fewer than 5 points, and inquiries fall off your credit report after 2 years, but it can vary. Multiple credit inquiries over a short time frame, such as applying for 5 credit cards within a week, can multiply the score damage. However, with other types of new credit, FICO recognizes that borrowers are typically shopping around for like a car or a mortgage. Assessing your own report periodically is not damaging to your score. Pre-approval offers do not impact your score either. Employment inquiries have no impact on your score. Let's talk about getting pre-qualified or pre-approved for a mortgage. The second step in the mortgage loan process is getting pre-approved for a loan. Pre-qualification is good too, but it's only a preliminary step. Pre-approval isn't a sure thing, but it tells you and your potential seller that you can afford to spend the money. During the pre-approval process, the lender will check your credit report, your income, and debt to income ratio. Then they'll give you an estimate of what you qualify for. They may also provide you with a range of interest rates so you can make an informed decision on what to spend. There is a difference between pre-qualification and pre-approval. At Addition Financial, we offer pre-approvals. We do pull your credit, but we do not charge for that pre-approval. Some lenders do charge for pre-approvals. A pre-qualification doesn't necessarily go as in-depth as a pre-approval. Let's go on to different types of mortgages that are available. Mortgage options are FHA, which is a 3.5% down payment loan, VA, which is only available to veterans, and it's a 100% mortgage, conventional financing that can go up to a maximum of $510,400. If you need to go over that, you're in the jumbo category. We do also offer jumbo loans. We offer fixed rates, adjustable, and we offer a program for first-time home buyers. Kathy will go into these a little more in the next series. Private mortgage insurance is something on a conventional mortgage, and there is an opportunity to have it removed down the road. VA has what's called a funding fee, which is financed into your mortgage when you originally get the mortgage. The mortgage insurance premium is on an FHA loan, and part of that is financed into your mortgage, and there is also a monthly mortgage insurance that is paid in your mortgage payment every month. So we will move on now to Kathy to tell you about different rates and lenders.
Thank you, Joy. Welcome, everybody. Thank you for joining us this evening. So now we're going to discuss the different rates and shopping lenders and what's available. Rates right now are at an all-time low. 30-year rates are as low as 3.25%, which is incredible. It's a great time to be able to finance a home. And they will range. They could be higher than that depending on the lender you choose, the loan to value, what percentage you're putting down, the program that you choose. But again, as low as 3.25 right now. When you are shopping rates and lenders, it's important to compare the APR, which is the annual percentage rate. And the definition of that has always confused people somewhat. It's the total cost of borrowing the money expressed as a percentage of the total owed over the year. And really what you need to know is use it as a comparison. So for example, if lender A is offering 3.5% on a mortgage and lender B is offering 3.5, the next thing you want to do is look at the APRs associated with those rates. The lender that has the lower APR on the same rate means that their costs are going to be lower, and that might be your better option. The other item that where you can save money with a credit union is intangible tax. Credit unions are exempt from intangible tax. So for example, on a loan amount of $200,000, you would save $400 in your closing costs. So it's the loan amount times 0.002, and that's the amount that you would save. Discount points are sometimes also referred to as buying your rate down. A discount point, a point is 1%, so 1% of that loan amount, so we'll use the $200,000 again, would be $2,000 additional in your closing costs. What you have to do with that though is make sure you're going to get the best value for paying that additional cost. You want to know what your break-even point will be. Many times if you have additional funds, you might be better to put it on the amount, pay it down on what you're financing, so financing less versus that lower interest rate. Another thing to ask about with regards to interest rates, I go back a little bit, is when you're discussing with a lender the interest rates, ask them when you'll be able to lock that rate in and what their terms are, because that could be very important as well. Our mortgage products here at Addition Financial, we offer adjustable rate mortgages, terms of 3, 5, 7, or 10 year. We offer conventional fixed rate mortgages, terms of 10, 15, 20, and 30 year. We have our fast track refinance, which I used to always refer to as kind of a hybrid mortgage. It's a first lien on a home that's either free and clear or possibly has a lower balance on it. Has great rates. We only offer a 5 or 10 year term. It does not offer escrowing of taxes or insurances, but it's a great product that we've had around for many years now, several years at least. And it's very good for lower balances, refinancing. It cannot be used for purchasing though. And then we have first time home buyer programs with as little as 3% down. We have 2 different programs for our first time home buyers. One is our Freddie Mac Home Possible Loan, 3% down. There are median income limitations on that, so please give us a call or even visit the Freddie Mac website to know what those limitations might be. We also offer our A+ to our school employees and their families, and that also has a 3% down, and that goes off of the Freddie Mac Home One program. With our adjustable rate mortgages, this is something that is typically used for somebody that knows they're either going to pay off or maybe sell that home within a specific shorter period of time. There can be great rewards with the rates if they go down, but there is a little bit of risk that if rates should go up, your rate might adjust upwards after that initial time. So it's something to discuss with your loan officer to see if the fixed rate security versus the adjustable rate is going to be better for you. Right now, and I would always ask you to check our website for any promotions that we might have in place. Right now, and it's soon to come to an end, is we have our direct deposit promotion where you can possibly save 0.25% APR off of setting up for direct deposit and automatic payment and this is for both purchases and refinances. But again, please check our website for any current promotions that we may have in place. They are subject to change, and they're usually for a limited time only. So now we're going to put a question out there for you. We're going to test some of your knowledge and see where we are. So the answer C was the correct answer, and the majority of people answered that correctly, 52%, so that's great. Debt to income ratio is the relationship between your gross monthly income and your monthly obligations, including that new proposed mortgage payment. So that was pretty good. Property types that we can finance. There's the single family home, which is your standard single family detached home, whether it's in a subdivision, on a private street. Condominiums, and the difference between condominium and townhomes. Condominiums, one, if you're not sure, you check the county website. If you're working with a real estate agent, they'll be able to tell you. A condominium we can finance. It does have higher down payment requirements. A townhome, simply put, is it may look like a condominium and you don't have to do any of that exterior work, but you do own the land that it is sitting on. And again, very distinct differences. We treat townhomes and single family homes as the same, which meaning minimum of down payment of 3% in some cases, or 5% for purchasing. Manufactured homes, we can also finance provided you own the land. It's fee simple that the manufactured home is on. If it's in a manufactured home mobile park or community, 55 plus community, if you're paying lot rent or leasehold, unfortunately, we would not be able to offer financing on that. And then there are duplexes. Duplexes can be either deeded separately, which means each half is on a separate deed. They can be purchased or refinanced separately by different people, or both halves are on one deed. Sometimes the owner lives in one half and rents out the other half, or sometimes both are purchased for rental purposes only. We do offer financing on that, but again, depending on the property use and how it's deeded will determine how much of a down payment you might have to have, or the maximum amount that we might be able to finance. Now we're going to go through, now that you've gotten a lot of things out of the way, you've checked your credit, as Joy went over that, you've shopped your lenders, you've done some research, you've decided on what type of program or product you want, determined how much you might have for your down payment. Now it's time to get an application submitted. When it comes to collecting documents, typically for a pre-approval, we do not collect documentation. We do run your credit and we review that. And based on what you input or state on your application is what we are going to review. But once you've entered into a contract to purchase a home and submitted that contract to us, now we're going to enter the documentation collection phase. And these are some of the things that are typically requested. We're going to ask for 2 years worth of W-2s from your employers. If you change jobs, that's fine, but we just want the most recent 2 years W-2s. Pay stubs, we're going to want the most recent that reflect year-to-date information for the last 30 days. And of course, right before close, you might ask for an updated one. Bank statements. Again, we're going to ask for 2 months worth of complete bank statements. Not transaction details or printouts. It has to be an actual statement reflecting all of the information and who has ownership of that account. And the reason these things are requested is we have to, of course, document where you've worked for 2 years. If it's less than 2 years, we'll be asking for a letter of explanation on that. Pay stubs, we want to look at your current rate of pay. You may have gotten an increase recently. Bank statements, we want to make sure that you have sufficient funds for your funds to close. If there are any large deposits or anything unusual, it may be questioned. Valid ID, of course, when you go to apply, you can either do that online through our website. You could do it over the phone with one of our agents and real estate loan officers. But if you, of course, go to one of our branches, they will ask you to present identification. Tax returns for 2 years are typically for your self-employed borrower. Other sources of income, we're going to request maybe a documentation for that, such as child support, alimony, separate maintenance, if you have inheritance or trust income, any type of settlement that you might be getting regular monthly income on. You have Social Security, you have pensions, annuities. So any type of income that we're going to be using for qualification typically is going to require documentation to support that. Details on long-term debts such as car or student loans. Car loans are typically reported on a credit report, and we could see what your monthly payment is. If it's getting towards the end of that car loan, we may be able to exclude that. On an auto lease, we're going to need to know if you're purchasing another car, releasing another vehicle. So that type of information. Student loans are very important. Unfortunately, even if they're deferred, we are going to have to factor in a minimum monthly payment. Currently, the calculation for that is 0.5% of the balance, and that has changed over the years, and it's one of those things that could change again. But if you have documentation on your minimum payments that differs from that, then we would collect that as well. And of course, we would be asking your Social Security number as needed for the application. Some of the do's and don'ts when it comes to documentation. We are going to be requesting those pay stubs, bank statements, as I mentioned, and I know everybody has gone paperless, which is good, but unfortunately, we are going to need you to obtain those and either get PDF attachments over to us or upload them to us. Don't necessarily have to print them out, but we do need a document form to analyze. Notify your loan officer of any changes in employment, your pay structure, anything of that nature. If you're going from a salaried hourly position to possibly a commission-only position or vice versa, this could definitely affect your application. Notify your loan officer if you plan to receive gift funds. Gift funds are an acceptable source of down payment and closing costs from a family member. If that is the case, there will be an additional form that your loan officer will send to you to be completed by that donor. Gift funds are gift funds. They are not to be repaid, they're not borrowed funds. And then, of course, towards the closing, we will refresh your credit report to make sure that there's been no additional new debt prior to the closing. Some of the don'ts. Don't close or open any accounts or transfer funds without. Try to keep any movement of funds between accounts to a minimum. We understand sometimes people are liquidating an asset or moving funds into one account so that when the time comes, they're just wiring from one account. But try not to move them around too much back and forth because an underwriter may request additional statements to show where did those monies come from. Any large deposits that are made to your account may require additional information. But again, if you get a $50 gift from grandma for your birthday, don't worry about that. It's those large deposits that might cause a question. Changing jobs or employers without how it might impact your loan. People change jobs. Typically, changing a job is okay as long as we're going to be able to document that you've been on that job a minimum of 30 days prior to closing. We may need to take a few extra steps, but please, please discuss it with your loan officer to make sure that it won't impede your closing. And then making major purchases. This is difficult because when you're purchasing a home, typically you're going to have to buy furniture, maybe appliances, things like that. And it's, you know, I know they're deferred payments on many of them or interest free, but try not to incur any new debts until you close. Now we're going to turn this over to Chris, and he's going to take you from here till closing. But I think it's time for another question. We're going to test you again.
Hello, everyone. Thank you, Kathy. Thank you, everyone, for joining us. I hope you're all having a great evening. So regarding the question on the student loan payments, overwhelming majority of you answered the question correctly, which is false. Student loan payments, if you have any student loan, there will always be some payment included in your what we call the debt to income ratio. And I'll actually talk a little bit more about that a little bit later. But know that even if your payment is deferred, we are going to be including something for that student loan. So now we're going to talk a little bit about the underwriting process. So at this point, you've been pre-approved, you've found a home and have a contract or a purchase agreement on it. You've submitted your application, decided what loan type, what loan term you're looking for, and your loan has gone through processing. So you've submitted all those documents that Kathy talked about. We've ordered the appraisal. Now I do want to talk about, you'll see on this slide, on the bottom right, it talks about a home inspection. I do want to say that a home inspection is something that Addition Financial and most conventional mortgage lenders do not require. But I do always recommend anyone buying a home to get a home inspection, especially a first-time home buyer. So that is something that you would, typically it's great to do that as soon as you have a contract. Most contracts will actually have a timeline for you to do that in. So that's good to get that done up front to find out, maybe there's something really wrong with that property, which means you don't even want to buy it. Or maybe there's just something small, but you might be able to either negotiate to have the seller pay for those repairs or even negotiate a lower or a better sales price. Now, as part of our application processing, we will also be ordering an appraisal. So an appraisal is what we as a lender use to determine that the value of the property is enough for us to lend the mortgage on, and also that the condition and the quality of the home meet a certain minimum standard. Like I said, it's not as in depth as a home inspection, so that is something you would still want to get as well. So now at this point, when you are in the mortgage underwriting phase, the underwriter that is assigned to your file will be going through that application that you submit and going through all those documents that you submitted to us as well. And it's basically their job to nitpick that information and make sure everything's correct and see if there's anything missing. It is common at that time they may have additional questions. So you may receive a phone call or an email from your processor that maybe we need another pay stub, or maybe we need another year's worth of tax returns or something like that. So that's just something to keep in mind. And at that point, you definitely want to make sure that if you are requested to provide either another document or even just an explanation for something, to do so as soon as possible to make sure there's no delays in your closing. So the underwriter is looking for the capacity, which is, do you have the ability to repay that loan? So that's when we're going to focus on the payment for the mortgage, as well as the payment for all of your other debts, compared to what your income is, what income we have used we've verified to use for your application, your credit history. Does it show that you have a willingness and ability to pay your debts? Have you been paying them on time? And then also looking at that appraisal. So looking at the collateral to make sure, again, that the collateral that will secure our mortgage is, good enough to do that. And then at that point, once the underwriter has, once you've convinced them that you are creditworthy to get that loan, then your file will get what's called a clear to close, and you will be ready for closing. So the closing process is, of course, going to be one of the most exciting points of this process for you as a buyer, especially as a first-time home buyer. So to talk about some of the steps for that, the homeowner's insurance, that's actually something, another thing that you should be doing up front. As soon as you have a contract, speak with an insurance agent and make sure to get insurance quote or multiple quotes. And at this point, when we get to the closing process, you'll have to, if you did receive multiple quotes, that's where you'll have to make sure that you've decided which policy you're going to go with. And then we as a lender are going to verify the funds for closing and also the employment. So typically within 10 days, but especially in our current environment, sometimes maybe the morning of closing or 1 to 2 days before closing, we will verify that you are currently employed with the employer that we're using for your income. And then the closing disclosure is something that you are going to get at least 3 days before your actual closing. And that will break down all of the final closing costs, how much you're paying for the loan essentially, as well as your interest rate, the APR that Kathy mentioned, what your total payment will be, and everything like that. It's a good idea at that point to compare your closing disclosure to the loan estimate, which is what you receive up front, to make sure that there's either no changes or any changes have a valid reason for them. And at this point, you'll also have to get your funds ready to bring to the title company or send to the title company. It's usually going to be done by a wire transfer, it may be by a official cashier's check. So you want to make sure that you have all those funds. Maybe you had it kind of split up between a couple different accounts. You want to make sure that it's all in one place so that you can easily bring the amount of funds to closing that you need to. And then a final walkthrough as well. Usually the day before closing, you may do a final walkthrough to make sure that the property is, in the condition that your contract says that it should be in, of course. And if there were, any repairs that you negotiated that the seller did, make sure those are done as well. Now we're going to talk a little bit about some recent changes specifically due to COVID-19. As far as the closing date, and one thing that we have seen a lot of in the last few months is contracts that we receive will have an addendum to the contract specifically regarding COVID-19. And that may talk about different things as far as situations where the closing date may have to be extended, either because we as a lender require a little bit more due diligence, or if depending on what sort of government shutdowns or things like that are, allow things like the appraisal to take place. And as far as the future of closings and the closing logistics, I'm going to talk about that in a couple of seconds as well. But one thing just about the future in general, one thing to keep in mind is over these last few months, of course, it's been unprecedented and there's been changes to lending guidelines, very frequently. So anything we tell you today could maybe be a little bit different tomorrow as well, but it's good to keep an open mind. If you do have good credit or if you've been credit approved with us and your employment is stable, there's really not much to worry about, but do keep in mind, especially when I talked about the underwriting process, there may be more documents that you need to submit to us as well. And then is when you actually close on your home. Congratulations, you are now a homeowner. Before we get into some questions and some of your questions, we're going to talk about a few frequently asked questions. So one thing I said I would talk a little bit about is the closing logistics. So who comes to closing? Typically, obviously anyone buying the home, anyone that's going to be on title or on the mortgage needs to be at closing, and anyone selling the home needs to be at closing. Usually the real estate agent for the seller and then the real estate agent for the buyer typically attend as well. You or the other party may have an attorney, you might have a family member, but one thing to keep in mind right now, especially with the coronavirus, is that some title companies are limiting who can attend the closing. Some of them in some cases may only allow anyone that is going to be purchasing the property. So that's something to keep in mind. And again, I mentioned you would always get the closing disclosure at least 3 days in advance. So if you do have that maybe that relative that knows a lot about mortgages and you want them to be at your closing. If they can't be there, they can at least look at that for you in advance. Escrow items for taxes, insurance, and possibly flood insurance. So one thing to keep in mind as well, and I talked about having your funds ready for closing, is the money you bring to closing has to be your down payment on the home, which is the difference between the purchase price and the loan amount, but also the closing costs, which could be things like the appraisal fee, title insurance, a survey, a lot of the cost to actually get the mortgage, which are those fees that kind of are included in the APR that Kathy discussed. But then the other funds you have to bring to closing are things like your homeowner's insurance. You have to pay for the entire year up front. So that will be, in some cases, a substantial amount. And then typically as part of your mortgage, we do escrow for taxes and insurance as well. So as part of your monthly payment, you'll pay 1/12 of the insurance amount and the tax amount. But we need to have enough money in that escrow account when those bills become due. So we collect a couple months up front as well. So it's not just the first year's insurance, but then there's going to be a couple extra months collected up front and a couple extra months of taxes collected. And then HOA dues, and as that relates to the escrow we just talked about, Kathy talked a little bit about HOAs and condo fees. Typically a townhome and a condo are always going to have some sort of HOA fee, but you might have a home that's part of a subdivision that has an HOA as well. That absolutely is something that we as a lender include in your payment, your housing payment, or your debt to income ratio, but it is not something that we handle as far as part of your escrow payment. You would pay that separately. And then the last thing, and this was the question that you all did a marvelous job on a few moments ago, how will student loans affect the qualifying process? As I mentioned, in almost every case, we're going to include your student loan payment. If you have a student loan payment that you are paying on normally every month, typically whatever that payment amount is, the minimum required payment is what's on your credit report, and that is what we as a lender would include in your debt to income ratio. If you have a loan that is deferred and there is no payment due, typically on the credit report, it would show that. There would either be no payment, just a blank payment, or a $0 payment. And in that case, as a lender, what we use would be 0.5% of the entire loan amount. Now, one thing is to keep in mind is, and we have seen some large balance student loans where it might report that way. It might not tell us there's a payment, but if you do have an actual minimum payment due, and I'm not talking about it's deferred, but you want to put $100 a month towards it so that your balance doesn't increase or something. But if you actually have an amount that's due each month and you can provide us with documentation for that, then we may be able to use that as well, which may help with the approval. So I think that's it. I think we'll do one more of the questions we have prepared for you on screen, and then we'll get into some of the questions that you guys have been submitting to us throughout this webinar as well. So I just want to say thank you again on my behalf, and we'll get into these questions in a moment.
Hey everybody, it's Kathy again. So again, you did really, really well. 75% said nope, false. For sale by owner or FSBO is always the best deal. So you are correct. It sometimes is the best deal, but it isn't always the best deal. For sale by owners, many times done between family members, but we always recommend a professional, whether it's a real estate attorney, paralegal, title company, be the one to help you write up the contract. It is a legally binding contract, so you want to make sure both the sellers and the buyers are represented correctly in that contract so that there's no surprises later on, especially if it's the family member. You don't want there to be any hard feelings down the road. So for sale by owner can be done, not always the best, but sometimes it is. So I hate to be vague, but it's false. The answer was false and you are correct.
Okay, we're going to have a brief intermission to review the questions that have come in, and we'll return in just a minute.
Welcome back. This is Kathy, and we have gotten a tremendous amount of great questions. We're going to try to answer as many as we possibly can, but we will respond via email to those that we don't get to. But one of the first questions is, why don't we offer pre-qualifications? In this current market, most real estate agents and prospective sellers of homes want to know that you've been pre-approved and that a lender has reviewed your credit and your ability to obtain this loan before they entertain accepting a contract. Pre-approvals, for lack of a better expression, it's basically just the paper they're written on because we're not collecting documentation, and pre-qualifications, because we haven't looked at credit, might not even be as strong as that. There are lenders that will interchange the two words, pre-approval or pre-qualification. They mean one and the same thing to certain lenders, but always check exactly what your lender is going to do. Let's see what else we have here. Oh, we had another great question. Somebody is engaged, congratulations, and they're purchasing a home with their fiance. And their question was, can they receive gift funds from the fiance? Yes, they can. That is an acceptable source of gift funds. And should the funds be kept in their account or deposited into the recipient's account? Keep the funds in the donor or the person that's gifting the funds in their account. As I stated earlier, I think, there will be a separate form for that person to complete. But also assuming that they will also be living in that residence, the primary residence together, or after they get married, that's also acceptable. So that was a great question. We like that one. And then let's see, we have one here, Chris, with regards to reduced income and COVID. You want to take that one?
Yeah, so we have a few questions regarding reduced income or temporarily no income, especially involving COVID. So one question was specifically, what if hours or pay have been reduced due to COVID-19? Will that trigger questions? Yes. So basically, the main thing we need to see if your income has been reduced due to COVID specifically is that it is stable. And this actually would pertain to an employed person or even a self-employed person. So if your income has reduced and it has stabilized, meaning maybe you were, maybe you were making $4,000 per month and your hours have been cut, and for the last, since maybe mid-March, you've been working, 30 hours a week instead of 40. So now you're making $3,000 per month. Based on the way I described that, that would be a stable thing. You've been making that amount of income for the last few months. So if you qualify for the loan with that lower amount of income, and if it's stable, then that's not going to be an issue at all. If you needed that higher amount, the 4,000, then that probably will be an issue until you're back at that amount and it's stable. And we have seen in these last few months, we've seen borrowers that either did have a reduction in hours or even were completely laid off. And then since then, they've gone back to their job and we've been able to approve a loan for them. As far as self-employed borrowers, and if you are self-employed, if you're self-employed and you've looked into mortgages before, you probably know that typically we need 2 years of tax returns, the most recent 2 years. Right now, one of the things we'll need as well is what we would call a year-to-date profit and loss statement. If you're familiar with that, or if you have an accountant that does your taxes, it's something they can actually prepare pretty easily, but it's not something most people keep on them. So it is something to keep in mind that if you're self-employed, we will need that as well. A couple other questions on the same subject. One question says, if one spouse has a lower, actually I'll get into that one next, sorry. If a spouse has not been working due to COVID and has been approved and hasn't been approved or denied for unemployment yet, is that a problem in regards to providing pay stubs? So based on what that question is saying, if one spouse has not been working, to me, that sounds like we would not be able to use any income. Now, that doesn't necessarily mean it's a problem. If there's two spouses, if there's two borrowers on the loan and the loan qualifies with just the one borrower who maybe is still working or has some other source of income, then that won't be an issue. In regards to the unemployment specifically, that is something that we do not use as qualifying income. So if you maybe are temporarily furloughed and you are receiving unemployment, that is not something we can use as income for you. So you would have to either be back at your job in, like I said, in some sort of stable manner, whether it was your pre-COVID income or some reduced income that still qualifies for the loan. And then, so there's another question that says, if one spouse has a lower credit score, is it better to still include them on the application, even if the spouse with the higher score makes the majority of the income? And then the loan officer can determine if it's okay to include them or maybe remove them. It's very case by case. In a lot of cases, if you, especially the question says spouse, so if it's a married couple, in a lot of cases it's going to be best probably to just apply together. If you would like to have both of you on the mortgage, to apply together. And if there's a credit issue that maybe would stop us from being able to approve the loan, then the loan officer will look at that and they'll see, especially the way this question was worded, if the spouse with the higher income also has the higher score. If it looks like they would qualify on their own, then we could remove that other borrower from the application. On the flip side, if you did apply by yourself, and maybe there's not enough income to qualify for the loan that you're looking for, typically we'll ask if you do have another a co-borrower, whether it's a spouse or maybe someone else that could be a co-borrower with you, and we could look at adding them at that point as well.
Okay, this is Joy back again, and a couple questions that I will go over. One of the good questions is, at what point in the process should I have the funds to close available? You really need to know that you're going to have the funds at pre-approval. It could be that they are in different accounts. It could be money you're getting out of a 401k. And if you're going to do that, you need to check with your employer as to how long it's going to take them for you to get the funds. Sometimes it's as much as 6 weeks. So you need to know where your funds are going to come from and how long it will take to get them, if you're getting them from mutual funds or 401k or anything like that. Or gifts, you need to be sure that the gifts are available, that they will be available to give you. So we need to have them at least verified at least a week to 2 weeks prior to closing. We have to know the funds are available. Another question was, what is the down payment based on? The sales price? And yes, it's based on the sales price. However, if we should get an appraisal and the appraisal is lower than the sales price, we would base the down payment on the lesser of the two. So it would be based on the appraisal. Stating that if you get an appraisal that comes in lower than what your contract price is, you would want to go back and talk to your realtor. You may be able to renegotiate that contract. Flood insurance. Somebody asked if flood insurance is required on every mortgage in Florida. No, it's not. It's only required if the property is in a flood zone. And then you would have to have flood insurance, and we would have that in your escrow account. You would escrow that. You would pay the first year up front, just like you would your homeowner's insurance. And then you would pay it monthly in your payment, so the lender would pay it next year when it comes due. Okay, one other question we got is, whose responsibility is it to know if there's any liens on the property you're going to buy? Well, we get a title search on that property from the title company that's going to be closing your loan. They're going to do a full search and make sure that it's clear, that there's no liens out there on the property. There could be a lien that the seller has a mortgage, and that's fine. They will make sure that that mortgage gets paid off and that lien gets cleared. And if there's any other problems with liens, that will be brought to the attention once the search is done, and they'll be straightened out, or we will have a problem closing. But that's not a normal problem. So, any other questions? Kathy, do you have any more?
Yeah, there's a few more good ones here. Well, there's a lot of good questions here. Pros versus cons with using new construction lender builders. The pros is many times they offer incentives, whether it's upgrades or closing cost credits, that are hard to resist, in all honesty. We do recommend that even though it's new construction, if you go in there with a real estate agent, not just on your own, many times they can negotiate Maybe not all of those credits or incentives, but some of them, and then you can still use your preferred lender, which we hope is Addition Financial, your credit union, because we typically offer better rates, better fees than any other preferred lender, but it is very enticing. Not to say that the programs that they offer are bad, but sometimes you want those options for yourself. Another question that came up is, are townhomes bad? No, townhomes can be great, especially for people that either don't have the time, the inclination, or the ability to have to worry about the exterior of their home, whether it's the lawn care, painting, different things of that nature. Most times townhomes, the association takes care of all those needs for you. There are some restrictions. Of course, you're not going to have maybe the privacy of the backyard of a single family home. You're not going to be able to do certain things on the exterior of the home. There are limitations. They have deed restrictions typically, but townhomes are not bad. It's truly a personal preference and what's going to suit your lifestyle. I'm kind of looking forward to it someday because sometimes that yard work is a little bit wearing. And then, there was another great question. When it comes to you're purchasing a home and you're going to hopefully have maybe a roommate, family, friend, whatever, share some of those expenses. Can the money that they pay you, basically room and board, be included as your income? And unfortunately, that cannot be included. It certainly helps your finances and your budget every month, but unfortunately, room and board from a roommate cannot be included as income. And Chris, I think we had a few more questions.
I do have another one here for regarding if you are planning on using 401k funds for your down payment, when is the best time to make the 401k withdrawal? Typically, I would say the sooner the better. You probably want to wait till you have that home inspection done and maybe any other inspections you might have done, like a termite inspection or septic inspection, to make sure that you're going to buy the home so that you don't run into any issues with the IRS or anything, since it's a retirement withdrawal. But that is something that we do have to verify that you have liquidated that account. So once you are pretty sure that you're going to be proceeding with that home, and we've especially at the point where we've underwriting has approved it, you want to make sure that you are doing that. With your 401k account or an IRA account or something, that might be a process that takes a few days for you to receive the funds. So again, as we said before, you want to make sure there's no delays. So it would be good to be on top of that. And then even upfront, maybe if you are looking to buy a house, if you do have that contract and maybe you want to wait for that inspection, but maybe call up your 401k provider or other retirement account and ask them what the process is and how long that would take so that you are ready to do that when you need to.
I have one more question on a VA loan. Someone asked what the funding fee is. The funding fee on a VA loan is 2.3% on your first use. If you've used your VA before, there is a higher fee on subsequent use. It goes to 3.60%. And like I mentioned earlier, that is added to your mortgage amount. However, if you are a disabled veteran with at least 10% disability, the funding fee is waived. The other thing to remember on a VA loan is if you are a spouse of a veteran that was eligible, even if that veteran is deceased, you can use their VA benefits. So that is something to remember. I've done quite a few of those. Any more?
I think that's about it. We're about at our hour mark. You can contact us. It's up on our screen. Give us a call, visit our branch. On behalf of Chris, Joy, and myself, Kathy, thank you again so much for joining us. There are so many questions we unfortunately didn't get to, but we will reply to via email. Please enjoy the evening. Our survey is up there. If we did a great job, please let us know. We appreciate your feedback, and we look forward to seeing you and helping you buy your home.
Thank you, Catherine, Joy, and Chris. This concludes our presentation tonight. Check your inboxes tomorrow for an email containing a link to tonight's recording, and thank you all again for joining us. Good night.